Okay, so it looks like only a couple people have joined. This will be recorded and put up on our website also, for other people that couldn't make it. Basically, this is a new series that we're going to be doing 4 times a year. We're going to try to do like a workshop on different topics. And so this is the second one we've had this year. Our third one will be obviously the one at conference, and then we'll have one later this year. Today we're going to do a little overview of credit and like what a credit score is, how it impacts you, what it means, and what makes up your credit score. So my name is Meredith Hartman, and if you have any questions, you can put them in the chat, or you can just chime in and let us know, and then we will get started. So what is a credit score? So a credit score is going to be a numerical value that's derived from a modeling system that's used to predict the likelihood of default. To put it simply, your credit score is used to differentiate high-risk borrowers from lower-risk borrowers. There's several different kinds of variations and ranges that make up credit scores. So the most common used one is the FICO score, which you'll see on the screen on the left side. And that's what we use. We go by the FICO model. And then it's going to break down the different levels, like ranges of scores and what they classify them as. So what is a good credit score? Like I mentioned before, while there's countless credit scoring models on the market, one of the most commonly used one is the FICO score model, which places the score in between a range of 300 and 850. FICO breaks the scores up into the following credit bands, which you can see on the screen. The highest one is going to be 800 and above, which is exceptional credit. Those are going to be people that have no problem getting approved for credit. People that have scores of 800 and above are going to be less likely to become seriously delinquent on their loans, which makes it easier to be approved for a loan. Consumers that have credit scores of 800 and up usually have a long history of established credit cards and lines of credit. However, if you are new to credit, like if you're younger and you don't have an established credit history, you could possibly come back with a really high score, but that's just because you haven't had time to really establish your credit portfolio. So that is something that lenders will look at. There's multiple things that people will look at when they take your credit score into account, but usually the exceptional credit is going to be the more seasoned borrowers. Then under that, you have the very good, which should be 740 to 799 credit scores. Those are what we consider A paper in our scoring parameters, and it's more common in the 800 and plus scores. Consumers with this credit score are more likely to get a better interest rate on loans since their score is above the average US score, and people with it will be less likely to become seriously delinquent in the future and usually have an established credit history that reflects timely payments. The next middle ground is going to be good credit. This is a pretty popular one that we see a lot here. We do a lot of paper with in this area. So the next range is 670 to 739. It's similar to what we consider a B paper, and it's the median credit score. You would be an acceptable borrower. About 9% of consumers with the credit scores of 670 to 739 are less likely to become seriously delinquent. The next category is going to be fair credit. Those are 669 to 580. They are going to be similar to what we call C paper. Consumers with this score are going to be less likely to consumers with the score are below the average score and have a harder time obtaining credit. Consumers are considered subprime borrowers, and approximately 27% of consumers with this score are less likely to become delinquent. Exceptions can include medical collection accounts. The last category is going to be the poor credit, 579 and below. That is going to be the challenged credit section. It's what we consider our D and E paper. Consumers with this score are more susceptible to being denied for credit or asked to provide a cosigner with a higher interest, and they'll have a higher interest rate because of their credit risk. Consumers that have these scores are about 62% more likely to become seriously delinquent. There's several reasons that somebody could have this score: slow pays, delinquent payments on your credit cards, things like that. We advise that you set up at least the minimum payment on your credit cards and accounts to be paid automatically so that you don't accidentally be late on your credit card or payments if you get tied up with stock shows or life or whatever happens. At least that minimum payment will be made, and you won't risk being marked as late on your credit. So overall, your credit score is a crucial part of your future. The better you maintain your accounts and lines of credit, the better your interest rates will be on all types of loans. Okay. Now we have the Experian FICO score model. The following slides are going to give examples of the different score ranges that Experian has. We use Experian. There's Equifax, Experian, and TransUnion. We here use Experian. That's the more popular one. The following slides are going to give examples of them. There's several different scoring combinations and add-ons that lenders can choose to obtain your financial snapshot. FICO scores are used by 90% of top lenders, and you will need about 6 months of credit history to obtain a FICO score in order to better assess your credit worthiness. One of the ways to get your credit started, if you don't have any, is to take out a small personal loan or a student loan and just make sure that you have the timely payments on them. If it is your first loan, you may need to have a cosigner. Or you could also apply for a secured loan through your credit union. For example, a secured credit card, a share secured loan, a CD secured loan. Oopsie, my thing advanced. Hold on just a second. And so, yeah, you basically will borrow against your money that we would hold as collateral, but that would help your credit increase. That's a way to like jumpstart your credit. Is to borrow against your own money, essentially. So people talk a lot about credit bureaus. What do they do? How do they defer? And why are there 3 of them? There's actually 5 of them, but these 3 on your screen are going to be the most popular ones that consumers use. They compile credit reports and credit scores about individual borrowers, primary for government and lenders. So they deal with consumer credit worthiness. Credit bureaus package and analyze consumer credit reports from which the credit scores are derived. So credit scores are issued as 3-digit numbers, like we went over, between the ranges of 3 to 850. They impact the size of the loan that you can qualify, the interest rate, and even if you're renting or like employment opportunities, insurance, those things will be determined by your credit score. The agencies don't share credit information with each other, so it's likely that one has more information than the other one. They each have a unique credit report at each of the agencies, so they can be used to calculate different credit scores. The credit score is just like a snapshot of a particular moment of time in one's credit behavior. Like I said, the scoring models can predict insurance risk, response rate, revenue potential, collectability, bankruptcy potential, and fraud potential. So what makes up your credit score? There's 5 different things that make up the bulk of your individual credit score. The first one is going to be your payment history, which is going to account for 35% of your score. And it's basically a track record for making payments on time to your credit cards and loans. Capacity is going to be 30% of your score. It's the amount of available credit that you're using on your credit lines, revolving ones in particular, which are going to be your credit cards. You can calculate your utilization by dividing the total amount of outstanding credit card balances by the total limit. So if you have 3 credit cards with a total limit of $10,000, but your total balance on the cards is $3,000, you have a credit utilization score of 30%. Credit experts say that it's best to not use more than 30% of your credit at any point during the month and to really stay around 6% usage. It shows lenders that you're able to manage your credit card balances. The third section is going to be 15% of your credit score, and that's going to be the length of credit history. This refers to the length of time that you've had your lines of credit open and are using them. The longer the credit history, the better. You should always leave your longer term credit cards open and not close them out. When you close out your credit cards, you're lowering the amount of available credit that you have, and it doesn't help improve your credit score. In fact, it could lower your credit score. The best thing to do is just keep your credit cards open and the balance is low. Use them, pay them off at the end of the month, and rotate them out so that you don't leave a credit card sitting with no balance for too long. Doing that runs the risk of the creditor actually closing out the account due to inactivity. The fourth area that makes up your credit is going to be the type of credit, and that's about 10% of your score. The type of credit or the credit mix means having a good balance between different types of credit accounts, such as credit cards, car loans, installment, and mortgage loans. This does have a smaller impact on your credit score, but it's still very important in your overall credit picture or snapshot. The last section is going to be new credit, and this accounts for about 10% of your score. It's usually considered a red flag to lenders when looking at your credit if you have several new credit card accounts or if you've taken out new loans in a short period of time. It may relay or suggest that you're taking on too much new debt at one time and may become challenged to pay it back if something were to come up unexpectedly. So these are just going to be like little more kind of examples of what we just talked about. The payment history, it's the largest influence on your credit score. It's including payment information and public records on various accounts, adverse public records, judgments, bankruptcy, foreclosure, collections, other reported past due accounts. In order to maintain a positive score, you must regularly pay your bills on time. In the scoring model, the current history, which is usually considered like the last 12 to 18 months, is given more weight than older history. So a positive recent payment history can help overcome a past delinquency history. Therefore, it's important that if you miss a payment to bring the account current and keep it current. Collection agencies sometimes promise an individual that paying a specific bill will remove that late payment from their credit history. That's untrue because the late payment is going to remain on your record. Paying off a collection will help members improve the credit score gradually as they create a pattern of on-time payments. If you're ever in a situation where you can't make your payment, it's best to contact the creditor to make alternate arrangements. And anytime that you make an arrangement with a collection agency or some sort of agreement, it's always best to get that in writing so that you have it as documentation for your records in case something like that does happen where it doesn't fall off your credit report and it's still showing. Then you have something, if you're applying for loans, that you can say, look, I paid this and this is the settlement letter. So missed payments are going to affect your score by 60 to 180 points. Typically, you have 30 days, so it'll report at 30 days delinquent to the credit bureaus. That doesn't mean on March 30th, April 30th, like the 30th of the month. It's just 30 days rotating based on however they do their reporting models. But if you do miss a payment, that will knock your score 60 to 180 points. The higher your score is, the faster it's going to drop. Bankruptcy, filing bankruptcy, it's going to drop your score about 250 points. And then this is the approximate credit weight for each year. So 40% of it is the current to 12 months, and then 13 to 24 months of history will be 30%, and so on. The amount of credit available or your capacity accounts for 30% of the credit score. Like we talked about, a key factor to determine what percentage of available credit is used, which has a bigger impact than the total amount owed. So negative factors include excessive debt, even if you have plenty of debt capacity on existing credit cards, because you may be using multiple lines to avoid maxing out one credit card. to improve this, you need to pay off your debt rather than transferring it. So it is good to keep your limit on your credit card away from your balance, away from the limit on the credit card. So you can spread them out, but you just need to be able to manage it. So you can pay off the debt rather than transferring it, or you can just close out. Closing out unused accounts is likely going to hurt you rather than help the credit score because the payment history on that account is gone. So a common misconception is like, oh, I'm not using this card, I'm just going to close it out. Well, you're losing that credit history that you've had established. You're losing that amount of revolving available funds. And then it's also going to increase your credit utilization score because instead of having $50,000 of available credit, you closed out that $10,000 credit card and now you only have $40,000. So it's best to just kind of manage your credit cards. Second, I'm gonna mess up my screen. So for example, like on the screen, you have 4 credit cards with a total limit of $10,000 and your total balances on the card is $2,500. Which you pay in full at the end of the month. You also have a home equity line of credit for $40,000. Your contractor billed you $40,000 for his job and you pay him with your line of credit. Now, the capacity percentage and how many points you've lost. So your total credit limit is $50,000. Your outstanding balance is $40,000. So 80% of it's used of your capacity, and then you've lost 80 points. So you lose approximately 1 point for every percentage that's used up. Another example is going to be member 1 has $5,000 in credit cards available. He has $2,000 balance on them. He's using 40%, so his credits dropped 40 points. And then same thing with member number 2. And then secured cards, you have a $500 limit. You're using 300. So you've lost 60 points. And then the other thing, like we said, the length of credit history. A person has held for more than 2 years credit, it's going to have a more positive impact on their credit score than newly opened accounts. So the older the credit line, the higher the score, which is why it can be counterproductive to close your older accounts. We establish credit lines even when the account is rarely used. So credit scoring companies rely on the average age of all accounts to compute this portion of the credit score. This means that opening multiple accounts in a short period of time will lower your average account age, and it may even appear to borrowers that you're loading up on credit, making you a higher risk. Since longer held accounts raise the average age, and newly opened ones lower it, avoid opening new cards and loans for the time being. So the best way to raise a credit score quickly is to maximize the average account age and improve credit utilization ratio, 30% of your score, by paying down credit card debt, not loans. Thank you. So how you could calculate your history, here's an example. Member number 1 has a Visa credit card for 10 years, that's his oldest one, and then a Target for 2 years. So he has 12 years of total credit divided by the 2 cards, so it's 6 years. And then member 2, he adds new trade lines. So he has Lowe's, Old Navy, a store, and the credit union. So that's 12 years of credit, but it's divided by 6 lines of credit, so the history is 2. Sorry. Now, the other one was new credit. That's the 10% of your score. It's usually considered a red flag to lenders when looking at your credit. If you have several new credit card accounts or take out new loans in a short period of time, because it may relay that you're taking on too much new debt at one time, and you may be challenged to pay it back if something were to happen. Let's see. Things that don't, okay, so this is a common misconception. You go shopping for a car and they run your credit. And when we pull credit reports, it shows inquiries and it'll show the date that it was pulled. So you could go to Maxwell Ford and they will pull like a soft inquiry on your credit, and it'll run like against 7 different places to find you like the best rate. Each inquiry, as long as it's a like category, so they're all shopping for auto rates, it'll just count as one. It doesn't count as 7 inquiries. So that is something that I've had a lot of people question me or ask about when talking about their credit with them. Things that don't impact your credit score are going to be account reviews. So requesting your score through the credit bureau or promotional credit offers. They buy your data and your credit score, so that doesn't impact your score. Insurance inquiries, anytime you apply for insurance, they run a soft inquiry. Medical, credit counseling, employment, and utilities. There's different types of credit. It counts for 10% of your score. The type of credit or the credit mix means having a good balance between different types of accounts, such as credit cards, car loans, installment, and mortgage loans. This does have a smaller impact on your credit score, but like we said, it's still really important in the overall picture. So there's different types of credit. Revolving is going to be your credit cards, lines of credit, and home equity lines. There's no term, so your interest just keeps compounding. Installment is going to be, I have X number of payments at this much, and on this date it's paid off. That's going to be your car loans, signature loans, and then fixed payment rate and term loans. Mortgages, first mortgage, home equity loan, those have fixed rates, payments, and terms. The majority of your debt should not be revolving. Typically, we encourage people to consolidate their credit cards, their revolving debt, and move it into installment, which would be considered our signature loans or like a refi cash out on a vehicle. And then make sure your home equity line of credits, they're not being reported as revolving. That's something that you can check. Later on, we're going to talk about how you can actually pull your credit and check it. And you want to make sure that it's not being reported as revolving because it's actually an installment loan. Because installment debt is better than revolving debt. Things that are going to lower your credit score are missed payments, maxed out credit cards, too many inquiries in a short amount of time, closing out those established credit lines, opening multiple new cards in a short period, and then just using only revolving loans. You want to have a good mix. Things to improve your credit score: review your credit report for errors pretty regularly. If there's errors, you can work with the credit reporting agencies to correct them. Pay your bills on time, pay off judgments, liens, and collections. Keep your credit card balances to under 35% of the available balance. Stop applying for so many credit cards, even though it's enticing when you go into the store and they say, oh, well, you can save 10% off your purchase today. No, don't do it. Maintain your oldest account rather than closing them. So you just want to baby the credit that you have and take care of it. This is what I was talking about. This is really important. Annualcreditreport.com is a good way to monitor your credit score, and it's a good way to see like what's happening on your credit. If there's any unusual activity, look for collection accounts that may not have been aware of, and then monitor your payment activity and open lines of credit. You want to do all these things to make sure that you're current on all your accounts and that there's nothing unusual on your report that may imply identity theft or error or something like that. There's 3 different credit reporting agencies like we've talked about, and the law requires that they give you a free copy of your credit report each year if you ask. It's a very simple task. I do it to make sure that my accounts are all reporting correctly and that there's nothing on there that shouldn't be there. The way that you can get it is there's several websites and apps that'll monitor your credit score and report, but they will not give you the whole report. So like your Discover card or your credit card, it'll say, oh, this is your score. They usually go by TransUnion and Equifax. Typically the credit card statements that have those figures included, they're not Experian scores. It's going to be TransUnion and Equifax, which, like we said earlier, they all vary. One could be 60 points off from another one. It's just the different scoring model that they use. So the one way that you can get your credit report is to go on to annualcreditreport.com, and it's going to look like this. You'll see at the top half the graphic when you're on their homepage. Right now, they're allowing you to pull it more often, more frequently, because of the current economy and the pandemic and stuff. Once you click on that red request button, it's going to take you to the second graphic on the screen at the bottom, which is the steps that you need to follow in order to get the 3 reports. One thing to mention when doing this, though, is that you'll want to either save your report or print them, because they're not going to be accessible after you X out of your session. So take the time to go online and do this so that you can get an idea of what's out there and make sure that there's nothing that shouldn't be there or any discrepancies that you need to file. Make sure that you recognize the information on your credit report, including your personally identifiable information, names, addresses, social security numbers, accounts, loans. Then check that the other information on the credit report is accurate and complete. If you find information that you believe does not belong to you or is not correct, contact the business that issued the account or the credit reporting company that issued the report. You can see additional information on what to look for when reviewing your credit report in the Consumer Financial Protection Bureau. Sorry. Federal law allows you to dispute inaccurate information on your credit report. There's no fee for filing a dispute. You may submit the dispute to businesses who provided the information to the credit reporting company, or to the credit reporting company who included the information on your credit report. So if you submit a dispute to a national consumer credit reporting company, the company may make changes to your credit report based on the documents and information that you provide. Otherwise, they'll contact the business reporting the dispute information, supply them with all the relevant information and any documents that you've provided, and instruct them to investigate your dispute. If you submit a dispute with a business, they will conduct an investigation and send you the results of the investigation directly. They'll notify the credit reporting companies of any changes that need to be made, and the information as a result of the investigation. If a dispute results in a change to your credit report, you have up to 12 months to order a second free report through annualcreditreport.com in order to review those changes and make sure that everything has been corrected. So to submit a dispute to a credit reporting company, you contact the credit reporting company who has the inaccurate information on your credit report. You may submit a dispute to each of the credit reporting companies over the internet or by mail. You may also submit documents in support of your dispute. Documents can be uploaded for online disputes or submitted by mail. When mailing documents, only submit the copies of the documents and not the originals. Documents are not returned to you following the investigation. So to submit a dispute with a business, contact the business directly. The contact information for that business should be included on your credit report or monthly billing statement. And then here's the online addresses and the mailing addresses. Make sure you keep your originals for all of your records. The information that you should be prepared when doing a dispute is your full name, including your middle initials, suffixes, social security number, your date of birth, your current address, all the addresses where you've lived during the past 2 years. And you may also be asked to provide your email addresses, a copy of your photo ID, and a copy of a utility bill or insurance statement. You may also submit documents to support your dispute, depending on the type of information disputed. The following documents may be helpful in resolving your dispute. So a police report or an FTC identity theft report showing that an account was the result of identity theft. Bankruptcy schedules showing that an account was included in or discharged in a bankruptcy. Letters from creditors showing how an account should be corrected. Student loan disability letters showing that a student loan has been discharged due to disability. Canceled checks showing that a collection account was already paid. And then court documents regarding public records. After you submit your dispute, you'll need to allow up to 45 days for the investigation of your dispute to be completed by the credit reporting companies. Here's some helpful links to give you some more information about credit reports, everything that we've talked about. The Consumer Financial Protection Bureau is a really good resource. And then the 3 credit report company sites, Experian, TransUnion, and Equifax. So that's going to wrap up our little webinar today on credit. Hopefully it gives you a better understanding of how your credit is calculated and how they determine your score and what's important and what you need to do. Again, my name is Meredith Hartman. My contact information is on the screen. If you have any questions about loans or anything we can help you with, just let me know. Shoot me an email. Otherwise, you can give us a call. We're always here to help. If there's any questions, you can put them in the chat or say something or email me. Thank you. Griselda?
Thank you, Meredith. Well, like Meredith say, we are here to help you. Any questions you might have, probably you might not have something today. Maybe later on, give us a call, email us. We are here to help you. It anything, not only like on the lending side, but any question that you have about anything, we're here to help you. We in the next couple of months, we are getting prepared to do more into financial, like how to budget. We're gonna try to have like we're getting certified to get a financial counselor, so we can give you more tips and help you to have a better life. Any question, like she say, you can put it on the chat. We're gonna hear a few more minutes here in case you have any other questions.
I see somebody typing.
I know, I see it too.
Cool. Yeah, we definitely are going to start going in a different kind of direction, focusing more on ways that we can improve our members' financial health and life. We are going to be getting a whole new system. Debit cards are coming. Lots of exciting things are headed our way. We basically are offering more ways to help our members than we have in the past. We do have promotions that we have going on. We have short-term loan options for people. We're looking at our rates constantly to see how they are against the market, and just the different ways that we can help our members. So really, we're here as a resource, as well as your financial institution. So with that being said, again,